Okay, hello, good morning. Welcome to our webinar on corporate giving by the FTSE 100 2023, following publication of the report on the 17th of July, just last week. My name is Philippa Cornish. I am head of the corporate client team here at CAF, and we are delighted to be back following a break since our last report. We last published this report in 2018, looking at 2016 data, and we used to do this every 2 years. So we were heading into the next edition as COVID hit. So it made sense at that time to pause, but also it had become a little bit more difficult to extract the data that we needed to do the report as companies started to change their reporting following the amendment to the Companies Act. So we took a pause at that point. So this edition of the report is a fresh take on what we did previously. And as part of today's session, we will talk you through that new methodology. The purpose of this session this morning is to try and bring the report to life a little. Hopefully you've all read it cover to cover, but we wanted to make sure that we brought it to life for those in the audience who are responsible or involved in corporate giving in their organizations, so that some of the findings we have, some of the benchmarking across sectors, and also the recommendations can really help arm them to access budget and to be bold and ambitious for creating programs of the future. It's also a chance to celebrate the examples of companies who really are leading the way in this. If we look at the report, the main headlines are that the amount given is flat, almost exactly, since 2016 when we last looked at the data, and down 26% in a decade since 2013, which amounts to a 17% and a more than 40% drop, respectively, in real terms, if we take into account inflation. And these drops are all against a backdrop of company profits increasing, and in some instances, quite substantially. So while pockets might not be deeper, they do seem to be broader, if that works. We see more companies having a giving program than when we last conducted the research. And so this indicates that there is more of a giving culture across companies, which is really pleasing to see. That's all I'll tell you. We will leave the deeper insights to our speakers. I'm really pleased to be joined today by Alastair and Lucy. Alastair is Honorary Professor of Quantitative Studies and Deputy Director for the Centre of Education and Employment Research at the University of Buckingham. He has also had an illustrious career as a journalist, including more than 20 years at the Sunday Times, and edited, among other supplements, the Sunday Times Rich List. In 2002, he devised and produced the accompanying giving list, a report which is sponsored by CAF and which really has become the barometer for high net worth philanthropy. It's been so great to have Alastair leading on this company research, bringing his experience from the individual giving sphere and switching that focus to business and to what they are doing. Lucy Mantella is the Principal Corporate Advisor here at CAF and was the sponsor from our team in getting our clients involved and shaping the narrative. I did want to say thank you to those of you in the audience who responded to our requests for data, as your contributions really have made the report so much richer. If you want to see the list of contributors, that is included at the end of the report. Lucy has been at CAF for 12 years, and over that time has worked with a large number of those businesses featured in the report, in fact. Though currently she oversees our financial services portfolio and leads the charge on our more complex programs and thought leadership. The plan for today's session is Alastair will talk us through the methodology and will share some of the findings in detail. And then Lucy will share some insights around the recommendations that we made in the report. I actually have some questions I'd like to ask them, but we also meant to make sure that you have a chance to ask anything too. So please do use the Q&A button at the bottom of the screen throughout the session to do this. And we will aim, we have a lot we want to say, but we will aim to make time to get to your questions at the end of the session. Before we hear from Lucy and Alastair, there's just one final important thing that I'd like to define, and that's how we measure giving. It's really important to do this as it's obviously not clear cut. We use the B4SI methodology for community investment. And on the slide you see now, that shows what that includes and excludes. We obviously recognise that responsible businesses have broad programmes, and obviously looking at one of the exclusions of payroll giving, CAP is of course a very vocal proponent for this. But what we really wanted to look here is isolating the voluntary activity from a corporate budget. So you can see what's included is voluntary cash, and in some instances that will include matched employee funding, that includes in-kind donations, that includes employee volunteering, and then also any management costs incurred from the management of community initiatives. Alastair will pick up a little bit more on the exclusion, some of those examples that we saw, just to bring that alive a little bit when he gets to his part. But from now, I will hand over the mic to Alastair to take you through some of the methodology.
Thank you, Philippa. And thank you all for joining us today. It's lovely to have so many of you here, and also some of the companies that contributed to the report and helped us. So as Philippa's touched upon, this isn't the first time CAP have done this survey, but it is the first time that we've done it in this particular way. We are revisiting old ground in the sense that 3 reports were published in 2014, 16 and 18 in the last decade, looking at corporate philanthropy. But at that point, we were looking at it very much as an entity, FTSE 100 as an entity, and we broke it down sectorially as well into the different industry sectors. What we did this time, which is the big difference, is that we're looking at individual company donations, and we're putting, if you like, scores on the doors for the first time. It is topical. I shall just hold up briefly the front of this morning's Times, which you may or may not have seen. And if you can see that, it says Jeremy Hunt is asking big business, specifically the FTSE 100, to use bumper profits to help people. So we are nothing if not on message at the minute, or should I say Jeremy Hunt is nothing if not on message. So the survey this year was sent for the first time to all FTSE 100 companies. What we asked them to do was to complete a survey outlining their community investment, falling into those 5 areas that Philippa has just outlined, covering volunteer hours, cash donations, in-kind donations, management costs, and employee matched funding of employee donations. That was sent out in March to all the FTSE 100, all the constituent members of the FTSE 100 at that point. And then we followed up often repeatedly in subsequent weeks by telephone and email. At the same time, we undertook the same analysis that was done previously, which was to look through all company annual reports and all ESG reports, which is, are the two official formats into which a lot of community and social investment is placed. And where we didn't receive responses from companies, we would then go and approach them and say, well, this is what we can see in your annual report, and ask them if they would confirm the figures and whether that was the extent of the giving they wanted to report. We had a very positive response. 64 companies engaged directly with the survey in one form or another, either active, what I call active engagement, which was 33 of them, who not only confirmed figures but supplied additional material to us, which helped us in our calculations. Another 31 effectively just confirmed what were the numbers that we put to them. 24 ignored all communications from us, and many of those, the majority of those, were companies, it has to be said, who farm out their corporate communications to an outside company and don't handle them at all internally. We had a very poor response from companies that did that. But of those 24, 18 had details in their annual report. So that was fine. We were able to take those figures and we included them in the survey, which left 6 for whom we had neither any response to the survey nor could discern anything in their annual report. That's 6 more than we would like to have had, but that's considerably less than the 15 for whom this applied in 2018 when we last published. So collecting the data produced a lot of challenges, the key one being an inconsistency in the reporting framework. Because of the change by the government in 2013 to the Companies Act, which no longer required companies to report everything on the charitable side of their business, companies now choose to express this in different ways. Some companies, for instance, will track volunteer hours in London, but they don't track it across their businesses if they've got outposts in America, South America, Africa. There are various ways in which the companies will express their charitable donations. Some were able to separate out volunteer hours, for instance, and the volunteer hours cash equivalent from work carried out in company time, but some admitted that it also included some work carried out outside of company time, in the employee's own time, in evenings and weekends. And many indeed did not record what the cash equivalent of the volunteer hours are. I think this recognises that this is an evolving area for companies. There are new things that companies are doing that they weren't doing when we looked at it in 2014, 16 and 18. But there are processes that are still being developed. And of course, there's a lot of eyes at the minute on other areas of corporate activity, not least environment, which is not included here. It's important to spell out what wasn't included in the survey, because it didn't align with the B4SI methodology that we decided to piggyback on the back of, simply because it was the most commonly recognised vehicle by which companies record corporate investment. So mandatory contributions here, these are those required by law or by local agreements with governments. Particularly applies to the energy and the mining sectors in particular, where there are requirements to make donations. We looked only at the donations that the company made, often to the same things, on top of what was mandatory. Big thing for utility companies at the minute is social tariffs, having a very important direct impact on households at the moment. And in the case of Centrica, for instance, they're spending upwards of £250 million on social tariffs each year. That is not included. Huge impact though it has, simply because it distorts the wider picture and is something very, very particular to the energy, to the energy market. Family foundations also not included. This affected two companies in particular, Pershing Square Holdings and Associated British Foods. Associated British Foods, 98% of the revenues from that company, which includes high street names like Primark, 98% of the dividend revenue from that company goes to fund the Garfield Weston Foundation, which is hands down the most generous foundation this country has seen in the last 60 years, with £1.4 billion of donations given out across that period. ABF directly fund Garfield Weston, but ABF were quite insistent that as a corporate entity, their charitable donations were zero. So they appear in some of these tables right at the very bottom, yet they are associated with a family foundation that is the most generous this country has seen, or certainly one of the most generous this country's seen. Social value also not counted. Calculation of the wider impact of giving a company with large property holdings, for instance, might give space to a theatre company to use for rehearsal. That has a social value, but it's not included in the survey here. And then general leverage. This covers customer contributions. A company like, for instance, B&M, who have a headline figure of donations that is not hugely spectacular, but acted as a clearinghouse for something called Mission Christmas a couple of years ago, which cleared through £13.8 million of presents for disadvantaged children. They provided a very, very important service there, but it's not captured in this methodology. The other thing to say about our methodology is to look at how we offset the charities raised against company performance, pre-tax profits. So pre-tax profits on the next slide, you can see we used from the consolidated income statement from the very first page of every company's annual report. In their financial statements section, they publish their pre-tax profit figure. They also publish a lot of other figures. They publish underlying profits, adjusted profits, gross profits, operating profits. And the situation is further complicated by the fact that both the companies and the media report on different profit levels, different categories of profit, according to what, for the companies, what makes things look the rosiest in the garden, and for the media, quite possibly the opposite, what makes things look the worst in, looks like, the weeds in the garden. It is the pre-tax profit that we think is the fairest. It doesn't take account of charitable giving and any tax offsets that companies get from charitable giving. It is the purest form, we think, of company performance. And so when we talk about the percentage of pre-tax profits given, we are talking about the sum equivalent to pre-tax profits, a pre-tax profit figure. So what did we find? The key finding that that came out of this report was that donations have not changed since 2016. It was quite remarkable. I mean, we are literally talking a few £1,000s difference. When we added all the sums up, it came out at 1.85 billion, and literally there was literally about £15,000 difference between last time and this time. It was remarkable. A lot's happened in that time, and the landscape has changed very considerably, both for companies and obviously for the wider country. But to see the figure stand still at 1.85 billion was quite surprising. If you take into account inflation since 2016, that adds up to a 17% cut in funding given. It should have been, had it just stood still in terms of the pounds, shillings and pence, the figure should have been £2.24 billion this year, and that would have achieved a standalone in the amount of money given in real terms. If you go back over the decade, the picture is bleaker still, it has to be said. In 2013, we recorded 2.51 billion of charitable donations, community investment, social investment, compared to 1.85 billion now. That adds up to a 26% fall in corporate giving in cash terms in the last decade, and a 40% fall in real terms in 10 years, which is obviously having an impact that's being seen day to day on the ground. Looking at all of this in the context of pre-tax profits is what we believe to be the most salient measure in this report. And what you can see is that since 2016, pre-tax profits have trebled. 3 companies, Shell, Glencore and Rio Tinto, this year earned more in pre-tax profits than the entire FTSE 100 in 2016, the time of our last report. So if you've got pre-tax profits trebling and you're measuring giving against pre-tax profits, the logic from that follows that the proportion of pre-tax profits given now is running at 1/3 of the level that it was 6 years ago. So in a time of enormous profits and prosperity, the amount of giving has stayed the same and therefore has declined a huge amount. If giving had been made, corporate giving in this report in 2022 had been at the same level, 2.4% of pre-tax profits, we would have seen £5.59 billion of donations against 1.85 billion, which the mathematicians among you will know is a 3.74 billion deficit, had giving been made at the same level as it was being made in 2016 when measured as a percentage of pre-tax profits. As the takeaway from this report, that is one of the most surprising and indeed concerning aspects, I think, of corporate behaviours in the most recent year. Not all bleak, however. We used with the giving list that Philippa referred to, we always use a figure of 1% of residual wealth as being the benchmark for what we felt was a good level of charitable giving. Applying that same principle to companies, we can see that 3 of the 11 sectors represented in the FTSE 100 as a group gave more than 1% of pre-tax profits, a sum equivalent to more than 1% of pre-tax profits. So the healthcare sector, as you can see from this table here, comes out at the highest, 2.9% overall. So there are 5 companies in that. 1 company didn't achieve 1%, 4 did, and by a considerable margin. And so you end up with an average of 2.95. The only other 2 sectors to achieve that are consumer staples, which features the high street supermarket chains, Tesco and Sainsbury's, among others, and the basic materials sector, both on 1.76% on average. Basic materials sector is the mining, predominantly the mining companies, Rio Tinto, Anglo American, Glencore, and Endeavour Mining among them. They, as a group, gave away significant sums, but also as a percentage of their pre-tax profits, many of them gave away more than 1%, and those that did carried the rest of them that didn't over that average of 1%. And then you can see as we go down, 3 other sectors came very, very close. Financials, the utilities sector, and the consumer discretionary sector are all not far shy of the 1% margin, but I'm afraid the other 5 are lagging well behind. And you'll notice their focus of a lot of attention in the last year. The energy companies, as we will see later, very large capital sums donated, but as a proportion of their pre-tax profits, the sum is very, very small. So the big difference that came with this year's survey was the fact that we decided that we would, for the first time, rank companies individually by the proportion of their charitable donations. The principle was simple. We were extending the principle that we used in the giving list, and it worked very well with the rich list. You would be amazed at how many high net worth individuals quite liked seeing their name on the giving list, and also quite liked seeing their name above the names of some other people on the rich list. And it created a competition. It appealed to their baser instinct, shall we say, and that they actually wanted to do well in the giving list. And people would, from what started in 2002, where people regarded it as something of an impertinence, by 2022, which was the last one that I was involved with, they would be ringing us up and saying, "Have you seen?" And this was the culture that we wanted to create, and we hope that by publishing this report, we can create a similar culture. Now, obviously, corporate community investment is very, very important to many companies in the FTSE 100. What there hasn't been before is any measure by which they can compare themselves to one another. And in publishing the tables this year that are part of the corporate giving report, we're providing that visibility, not just to the public, but we know to the companies, because some of them have said to us in compiling the research, we'd be really interested to see where we stand against some of our sector rivals, and also obviously against the wider FTSE 100. So what you have here is, in this table, is our the ranking that I think we favour the most, in the sense that this is the charitable giving expressed as a percentage of pre-tax profits. And you can see quite an even spread there. It's a very even representation. There are 5 sectors represented, each with 2 companies, 2 in healthcare, 2 in basic materials, 2 in consumer staples, 2 in consumer discretionary, and 2 in financials. Everyone on this list should take a collective corporate bow. They are all making a huge difference in what they do. There are some very big high street names there. There are obviously the healthcare companies who are very, very prominent at the top there, with very significant donations. Supermarket chains, Sainsbury and Tesco, are also there with very, again, very hefty donations. Any of us that go into the supermarkets see plenty of references to it near the checkouts, where in Tesco's with the little blue buttons where you can sort of help decide where they're going to spend some of their money locally, etc., etc. These companies are making a very, very big difference. The second table gives an alternative view. This is the donations purely by cash given. Now, this table will obviously favour, this table is obviously influenced by the scale of the companies involved. And so what you have here is, you have, again, a fairly even measure. You have 2 healthcare companies, again, very, very high up in the list. What you also have is 2 of the energy companies who, as we saw a few moments ago, in terms of their pre-tax profits, as a percentage of pre-tax profits given, they are very low. But Shell here have given £150 million in voluntary contributions in the last 12 months, in the 12 months recorded in their 2022 annual report. That's obviously a very significant sum. It makes an important difference on the ground, but it is obviously dwarfed by the huge pre-tax profits figures that Shell, ditto BP, further down the list there in 7th place, are returning. So this table really favours scale over percentages of, the actual percentage given, and it is a perfectly valid measure, but we feel doesn't quite tell the whole story. If you are a smaller member of the FTSE 100, it's in a relative term, these are all big companies, but if you are a smaller member of the FTSE 100 with lower profits and a slightly lower gearing, you are unlikely to appear in this table, which is why we think that the pre-tax profit figure is the most relevant to be looking at. So on that note, hand over to Lucy to talk to us a little bit about what we think ought to be done off the back of all of this.
Wonderful. Thank you, Alastair, for providing us with such a rich insight in terms of the data. So what can we do with all of this? In the report, we were keen to ensure our recommendations were digestible. For companies, there's 3 key recommendations that we've put forward. The first being maximise and grow giving. The second being be transparent about corporate giving and social impact. And the third being set the tone from the top. So I'm going to bring these to life a little bit more and talk through what we actually mean. So maximise and grow giving. One of the key things we've heard today is about donating at least 1% of pre-tax profits. What we want to stress here is that pre-tax is what companies should be benchmarking against, instead of static amounts that don't move with inflation or profitability. Secondly, foster a culture of giving. This is about ensuring companies have the basic building blocks in place, for example, through the provision of matching and giving initiatives for employees beyond everything else that they're doing. These are the very simple things. Then there's a point about developing ambitious and bold programs, not to do only the BAU or everything that you've done forever. Be more bold in developing giving initiatives that can be used to address the challenges we're facing both in business and society. So looking at the second recommendation, be transparent about corporate giving and social impact. Alongside crunching the data for the report, we also ran some YouGov polling, and there were some really interesting stats that came out of this. Only 37% of the public believe that the FTSE 100 donates to charity. 37%. I'm just going to repeat that number. You're doing a lot more and people don't know. And a further 70% believe businesses should be more open and transparent about their charitable giving. There is a clear disconnect here, and the need for companies to take action when thinking about how to get this balance right. No matter what stage an organisation is at, it is important to have a common strategy around what it is that you're doing and why it's important to you as a company. Looking at the final recommendation, set the tone from the top. This is one of my favourite recommendations, and it's hugely important. The first point is about aligning social purpose and overall business strategy. This is a no-brainer. Any programs have to make commercial sense to an organisation, yet also they have to add value to the beneficiaries that they're supporting and create lasting change. Secondly, we've suggested linking KPIs and executive pay to sustainability and purpose. This is a highly debatable topic right now. And however, there needs to be change that happens, and there is a potential way to drive this change by kind of embedding this within corporate culture. The third area is around legal locks and long-term asset allocations to ensure that in the future, sustainability is at the heart of the core mission. The B Corp movement has done some really interesting work in this space, and Patagonia is now beginning to take over Unilever in terms of being the sustainable business that everybody is aspiring to be. Finally, there's something relatively simple that links back to the point about public perception and common strategies. Company leaders need to talk publicly about giving, whether it's about their own corporate programs or their personal commitments. Peter Harrison, the CEO of Schroders, is a great example of this, and you can read more about their program in the case study and how he's leading from the front. The final point I want to make on the recommendations is that there is one policy recommendation that is really important, and that is that we need to set clear and common standards for reporting. Alastair touched on this at the beginning. The removal of mandated reporting of corporate giving from the Companies Act Amendment in 2013 has meant that there is no clear language or common framework, which is making things very difficult. How can you prove your programs if everybody's reporting on them in different ways? Okay, I think I'll end there and hand back to Philippa.
I just wanted to say before, we're going to head into some Q&A now, but before we do that, just to answer some of the questions we've had in the chat, we will be sharing the recording of this webinar with everybody who's attended, and so you will be able to see the slides in that way then. So just about that, we'll be following up with that in the next couple of days. Before we get into some of the ones that are in the chat, because I can see there are a few coming through, I just wanted to ask a question, probably to you, Lucy, about, obviously we last did this in 2018 with 2016 data, and as you've both alluded to, like, the world has been through a lot in that time. What did we see in the COVID period in terms of giving? There's a line in the report about a spike. Can you maybe bring a little bit of that to life for us?
Yeah, of course. This is a really important question. And I definitely think it's a period of time that many of us wouldn't want to go back and experience again. It was, however, a unique point where we saw businesses, government and society come together to work in a completely different way in order to tackle the business issues we were facing at that time. It's something that's often spoken about at a policy level, yet is rarely achieved in reality. In our own portfolio, or in our kind of own portfolio, we definitely saw a spike in corporate giving during COVID, and this isn't necessarily represented in the report. It is, however, important to acknowledge that many companies gave significantly during this period, and that's really important. At CAF, it was an incredibly busy time for us, and from our own work, it was really interesting to see how companies were able to unlock budgets in completely new ways. While some budgets were redeployed, many were identified from new sources and were able to be unlocked at speed, which kind of the norm that doesn't really happen. We also saw some really interesting things with collective funds emerging from some sectors that decided to tackle specific themes in a collective way. So we saw this very much in the insurance and the pharma sectors. There's also another point I want to make, that I think it's also important that we don't just talk about COVID. I think that we also have to reflect on Ukraine here. And when the situation began to unfold last year, in early 2022, we saw many similar behaviours from companies in terms of their responses. So it was like they'd kind of got used to pulling levers and kind of unlocking and responding to crisis in that way. In 2023, we're adjusting, and there's some comments on that in the report, and we're beginning to see budgets return back to a pre-COVID level, which is exactly what we've seen with that 1.85 million figure in the report. I know many of my clients are embarking on new strategies and reinvigorating plans that have been put on hold or are being adapted. But for me, it begs the question, should a global crisis or disaster be the driver for corporate giving budgets? I think there's definitely some positive lessons that we can learn from the poly-crisis periods. There are, however, some challenging discussions that I think need to happen when it comes to securing additional budget and potentially upping it to that 1% point.
Great, thank you.
I think the point to make with COVID is that we could see from a number of the annual reports that companies were bringing giving levels back down to pre-COVID levels in some instances. So if you take a company like Ricketts, who are manufacturers of Dettol, now probably all of our households have seen rather more Dettol through them in the last 3 or 4 years. So before the pandemic, Ricketts were giving £12.2 million in 2019 for community and social investment. That went up to 52.8 million in 2020. And a lot of that is going to be via, a lot of that was via in-kind product donations. That was corrected back now to 31.7 million. And the company have an ambition going forward, which they state in their annual report, to 2025 of giving at a level of about 20 million. So still above the 2019 level, but much, much lower than the levels that it hit. Now, obviously, the 6-year gap in our report has not been able to capture all of that in terms of, just what heights things did reach in 2020 and 2021 to a lesser extent. But it is certainly fair to say that there is in many companies a correction going on to bring giving back down to levels that we saw before. And on Lucy's point about Ukraine, I would say off the top of my head, about 80% of annual reports mentioned giving to Ukraine. It was a very, very prominent giving to Ukraine, operating in Russia, all of the things that sort of spin out from that, from the orbit of Ukraine. What we can see, however, from the figures staying the same at 1.85 billion between 2016 and now, is that whatever has been given to Ukraine has largely been taken out of existing community investment budgets rather than finding new funds. Now, whether that is because actually a lot of new funds were found during COVID and had been drawn down already, and how many times can people do this? I don't know, but certainly I think it's fair to say, looking at whilst the huge number of companies that have made an impact in Ukraine, I would say that most of that money, the evidence would suggest that most of that money has come from other budgets, other charitable budgets being redeployed.
Yeah, great. Yeah, no, thanks, Alastair, and thanks, Lucy. That's really helpful. I'm conscious that we have quite a few questions coming in from the audience, which I just wanted to get to. Firstly, a quick one that came in early, a simpler one about the cash equivalent of volunteer hours and how that's recorded. I mean, I think I can maybe take that quickly and say the truest way of doing that, I guess, is the actual cost to the company of that employee. And there are obviously different ways you can do that with HR and finance and your own records. And if you look at the B4SI guide for community investment, they have some nice suggestions of how to do that. So that might be helpful. I have another question about whether we know the percentage of giving that went to UK charities rather than international. And obviously this report really focused on the funding rather than where it ended up going. But I don't know if either of you wanted to speak on that, Lucy, about what we see in terms of the split of UK and things more globally.
Yeah, I think that's a great question, and it really depends on the footprint of the company, whether they're global or domestic. So where you have a domestic program, maybe looking at the retailers, that all tends to be local communities and employee engagement. So it will be much more of a domestic program. If you're looking at more international corporates, you tend to see more international programs. It really is dependent on the footprint of the company and the kind of footprint of their employees.
Yes, that's very true. I mean, a company like Standard Chartered, for instance, made the point to us that, their figures are very robust. They are very healthy. But they said, but most of this is in America. This is, most of it is close to the mothership. And, but they are headquartered in the City of London. So it is impossible to break out, and I think it would be it wouldn't just be difficult to do it. I'm not sure that it would give a completely fair picture. Certainly for companies that are that choose to be based in the UK, if they have a global footprint, many of them are making contributions to important things globally. So if you take, for instance, some of the South American mining companies, many of them will be contributing to projects that are involved, for instance, with preservation of rainforest and things. Might seem a long way from us here, but actually keeping the rainforest intact in South America will stop the fires burning in the Mediterranean in the summer. So there is, I know the sector is very keen for us to be able to break out what's actually done in the UK, but I think this is actually, for this project to have its true value, wearing a global hat is the right one to wear.
Yeah, I guess it's the the complexity and the connectedness of the way companies give like reflects the complexity and connectedness of the way the world operates, right? So it's very difficult to see. Okay, that's great. Thank you. Alastair, I don't know if you've got a sense in the research of how many companies give through foundations versus directly. I guess that's a challenge because we know at CAF there's no sort of legal definition for a foundation. You can call your giving program a foundation without it being an independent foundation. But is there any sense of how much that word came up and how much companies use that?
Yes, I think as a rough figure, I mean, I counted 30 companies that used, 30 out of the 100 used
Right.
the term foundation. You're quite right. Whether it was legally constituted as a foundation is a separate matter, but in many cases they are. So there are companies like ABF and Pershing Square Holdings who have separate family foundations, but then there are another 30 companies that actually have the foundation under the umbrella of the organization. So Barratt Developments, for instance, Barratt Homes, they have a foundation, the Barratt Foundation, which has been instituted to bring all of their corporate philanthropic activities together in one place. They can better identify it. It projects a sort of, a single entity to the outward world. And we know there are companies doing this sort of thing all the time.
Yeah, that's great. And in fact, I think one of the case studies is Smith's Group, who's an organization that CAF is working with, who have just set up their own foundation in that way to do exactly that. Great, thank you. One for you, Lucy. I wonder if you could speak to any trends regarding funding themes and also like focus of corporate giving.
Yeah, I mean, stuff is changing. We saw when we were in 2019, many of our clients are at a point of launching new programs and initiatives or new strategies. The end of their 4-year or 5-year strategy or 3-year strategy had come to an end. And we entered COVID and everything changed, and then Ukraine happened, and the world is very much a different place in terms of how we operate. People are no longer in the office. Volunteering programs are no longer the same. We've got to kind of adapt and tweak programs to be able to adapt to this new world that we're now living in. And that also includes things like, I don't think we can ignore the Black Lives Matter movement as well. That was really a pivotal point for some clients, especially where they have both a US and UK footprint, and they're trying to figure out how to get this right. So I would say that we are very much seeing clients adapting, tweaking, changing programs to be more relevant for the world that they're operating in now. But they're also trying to fit in the bigger piece of what's happening within their organizations around how does this play into ESG? How does it play into ED&I? The landscape is more complex. The nuances and relationships are super important within that.
Yeah, I think that's right. We had a similar question about, is the reduction in corporate giving an inevitable consequence of corporates adopting a purpose-led strategy? And I think we've had a lot of conversations about that, haven't we? About the broad range of things that corporates now focus on and where that budget goes, and that's definitely potentially a component of it. But I think looking at giving is like there's a few comments about obviously the breadth of the research and looking at impact, which are all like really, really important things, looking beyond the FTSE or non-FTSE companies, which I think we'd obviously love to be able to do. We're slightly limited by what information is publicly available that we can pull. And then also, as we've alluded to, the difficulty in finding a framework that really works and that we can use really broadly. So this isn't to say that obviously the impact on what comes out of this giving and where it's going is not important. It really is. And with the Impact Accelerator at CAF, we have a lot of plans in how to track that more clearly. But this report really was geared at looking at the funds in. Okay, I'm just conscious of time. We just have 1 minute to go. So we definitely have a few more questions in there that are really interesting that we definitely will want to address. So I think what we will try and do is have a look at doing some of that in our follow-up. we're really pleased with the engagement, and thank you for the questions, including some of the more challenging ones, all really valuable. I wanted to say a big thank you to you all for joining. A huge thank you to Alastair for this enormous piece of research, and the conversation it's allowed us to have, which is really brilliant. So thank you very much, Alastair. Thank you, Lucy, as well, for sharing some of your insights. That's fantastic. There was a question about next year. We are planning to do it again next year. We obviously think seeing something year on year will be all the richer. It's a good measurement of a point in time of obviously a much broader developing picture, but it's a good snapshot of that. So that is our plan. And we also are hoping to host an event later on in the year where we can dig a little deeper into some of these recommendations and have some of these conversations. So we will let you know about that. But thank you very, very much for joining, and enjoy the rest of your day.
Thank you all.
Thank you. Thank you, everyone.